Well, let's see. Yeah, I have 9 o'clock, top of the hour, at least on the West Coast. I don't know where all our participants are today, but I have 9 o'clock, which is the scheduled time of our meeting. And our speaker is here today, so we'll begin the proceedings. My name is Bob Welge, and I'm the president of the Orange County chapter of the American Association of Individual Investors. I ought to point out, if you've heard some of the earlier dialogue, this is being recorded today. It's our first time on Zoom, and it's an AAII headquarters national account, and still a little unfamiliar with some of the controls, but we'll learn to use those as we go. Our next meetings we'll be using Zoom as well, but I'm getting ahead of myself. Let me introduce the rest of the officers. And I'm going to find a better way to do this next time. I've got an idea that we'll follow, and at least you'll be able to see their faces. Our Vice President is Stephanie Davis. Our Treasurer is Dave McMillan. And Ming Ko is our event coordinator who volunteered, as you remember, to make the coffee for us. But of course, we don't have any coffee today unless you have your own. And I want to make a special mention to our secretary, who not only takes the minutes, but has set up this meeting for us today. Ed has done a lot of work on this. And my personal thanks, and everyone on this call should thank Ed Sharman for the work he's put in getting this meeting set up for us today. So Ed, a big round of applause, and thank you. And he takes the minutes as well, which you can find online, which I'll show you in just a minute. Meeting duration today will take a couple of hours. I don't know if we need a break. I don't think we do. We would if we were meeting in person. If you want to take a break, Tom, we'll do that. We'll pause for a few minutes. It's your call. The special interest groups, of course, is suspended for now, or all the personal meetings. Let me go on to the, I really don't have any other business other than what I've already mentioned. We've got 3 more meetings this year after this one. September 5th, we'll have Craig Israelson talking to us via Zoom. The format for all of these meetings will be on the web as we're doing today. October 24th, John Buckingham, the value of dividends. Well, both of these guys, Israelson and Buckingham, are well-known speakers. They've spoken at AAII national conventions, as well as the Money Show and several other places. So they're well recognized, and we're lucky to get those speakers, so I don't want you to miss those. The opportunity to get those. And then Kevin Carter, who was our March speaker, of course, when the pandemic hit. He got canceled again. I've had to cancel him twice, which is a real shame. But we'll try one more time on November 7th. And that's really a shame that we've had that problem with Kevin, but he's been very patient with us. As always, you can go to robertsfinancialmanagement.com. If you wonder what that is, I'm going to take you there because of this format. I can do that. Let me get keyboard within reach. If you go to robertsgeneral.com or robertsfinancialmanagement.com, you'll end up at this page. Along the top here, AAII. There's the upcoming meetings that I've already told you about it. There's links to their website, as there is one for Tom for today. And if you click past events here, you'll see records, including Ed's minutes, all the way back to 2002 of these meetings. Now, some of them have more detail than others. A lot has changed since 2002, but you'll find a record of all the meetings that we've had with websites. At least most of them have websites, and more lately, the presentations and the minutes are posted. So all of that's at robertsfinancialmanagement.com. When you put that in, you'll end up on this landing page and go to AAII up here at the top. So that's what Myers Financial Management is. I won't ask for any questions because everybody's muted. So our speaker today is Tom Jacobs. He's the partner of Huckleberry Capital Management. It's a boutique registered investment advisory serving clients in 27 states and foreign countries, from offices in Silicon Valley, North Carolina, and Texas. And by the way, Tom today is joining us from Texas. He has been investing for 50 years through all market conditions, including this one, I guess. His high yield strategy is described in his third book, How to Retire on Dividends, Earn a Safe 8%, and Keep Your Principal Intact. And principles from his other two books are also included in what we're going to see today. He is a graduate from Cornell University. And of course, he has a JD, and he got that from the Chicago School of Law. So Tom, I'm going to stop sharing and hand it over to you in advance while you're setting that up. Thank you for joining us today, for taking your time and for putting this presentation together, sharing your time and your thoughts with the Orange County membership. Thank you.
Well, it's my pleasure to be here. We're all good on the audio?
Yes, we can hear you and we can see your single slides.
All right, very good.
All right.
So thanks for having me. This is somewhere between my 15th and 20th AAII presentation, but it's my first one on Zoom. So I hope you'll be kind with any technical glitches that I may produce.
And with us as well, I'm afraid. We're all first on the Zoom. AAII. Now I must have 5 Zoom meetings a week.
Yes.
Either usually just a participant or it's handled differently. It's a private account, but this one for everybody on the webinar today. This one's provided by and set up by AAII headquarters. So we're still learning. We're learning quickly, of course, as quickly as we can, the pre-settings that AAII headquarters has set up for us on this. So, but we're good to go. We can see you just fine, Tom, and your slide.
Okay, very good. The topic of the presentation is how to retire on dividends, 6%, 7%, and 8% plus yields with italicized upside. Just because you're getting some yields doesn't mean you sacrifice any capital appreciation. Our goal is to have some of that. So the strategy today that I'm discussing is that of my book, on Dividends. And I should add that this is, I'm sure, not only of importance to y'all, notice the Texas y'all there, but also I go on Medicare next year. And while that may not seem necessarily that close for some of you, it is very close to me. And it concentrates the mind on things like retirement income. And this is the strategy that I use to invest all of my own household family assets. That does not mean, of course, that it's right for you or right for you 100%. But we'll discuss today many aspects that can go into making that decision. So I'd like you to consider this as a story. And it's a story of how to obtain higher income than is normally expected. And also to change your mind frame a bit about some investing concepts. So the retirement and pre-retirement challenges today, some of them are challenges that we have seen for a long time, some of them peculiar to the last number of years. First and foremost, I think, would be where to find income in a low yield world. You don't need me to tell you, treasury yields, bank account yields, they're nothing. And this has put a real damper on savers and those who want to live off the income of their savings. And of course, the perennial question, how long will my money last? Financial advisors for a long time have employed William Bengen's 4% rule, later adjusted by Mr. Bengen, an aeronautical engineer from MIT who decided mid-late he wanted to help people with their money. And he came up with the idea that if you invest in a certain way, you should be able to take 4% out a year, and basically you'll die cashing your last check. I will propose that you don't have to withdraw any of the principal, and this is obvious, if you can earn more than 4%. And then after how long my money will, the question is, what kind of volatility and risks will I have to take? And I think with the closing of the economy for a couple of months, certainly unprecedented my knowledge of market history and my lifetime, what about COVID-19 risks to those investments? I'd like to add that most people seem to want it all. They want all the returns of the stock market with none of the risks. And to them, I say, Bernie Madoff, 12% a year, your principal intact, but not just intact, but doesn't move. And I think we all know where that leads. One of the problems with the 4% rule is that if you are withdrawing principal, you're doing the reverse of what you did saved and invested over your working career. As you're saving and investing, your dollar cost averaging, whether it's in a 401k or something like that, you're adding funds on a regular basis, averaging your price, taking advantage of downturns in your stocks to buy more shares, and as markets rise to buy fewer, keeping your average price low. The problem with withdrawing principal when you is that it works in the reverse. You actually sell more shares when prices are down, and fewer shares when prices are higher. And that's exactly the opposite of what you want when you're retired. And this just shows Microsoft during the financial crash, just to illustrate how dramatic it would be to be withdrawing with the stock down 46%. And I should have a chart showing what's happened to Microsoft since, because it's bagger in the last 10 years from that low. So not the best way to manage your money if we can find a way to keep from withdrawing the principal. So the goal is to have safe 6, 7, 8% yields, and then safe refers to the yields. There will be volatility in the principal. Of course, what investments come with no volatility except maybe bank CDs, and even treasuries have volatility. The idea or the goal is to not sell shares, hence no withdrawal. You can certainly withdraw the dividend payments, but the idea is to not have to sell your principal, sell the shares. We do this through a right mix of real estate investment trusts, bonds, and high yield stocks. And when I say we, I'm referring to Huckleberry, but I manage this strategy. It's just that a whole hour or however long of me saying well, it's the kind of thing I was raised not to do too much of. So we'll talk about REITs, bonds, and high yield stocks and how they work in this strategy. So just to illustrate, if you have $1 million in retirement capital, currently this strategy is managed by yields 7%, 78,000 in yearly income, and the idea the original 1 million stays intact if you're not withdrawing principal. Now, underneath the 78,000, I've written normalized yield is 8.6 to 9%. And part of that comes from the fact that some of the real estate investment trusts, in order to conserve capital, given uncertainty, suspended or cut their dividends. However, the intention of all of them is to repay, and in all of those cases, liquidity proved to be sufficient to weather the storm. And I will at the end get into one reason why we actually benefit from purchasing today from our current yield and also upside to normalized yield. Now you might say, well, Tom, it's all great to think things will, quote, get back to normal, unquote. But the real estate investment trusts, or REITs, that are in this strategy are ones that have weathered extremely well, are collecting rents at a high rate, and will be required to catch up on their dividends by the end of the tax year. I would note that for people with where the bulk of their retirement assets are in IRAs, not individual taxable accounts, that yes, you do have to make a required minimum distribution every year, except this year where it's been suspended due to COVID-19. But also, the IRS increases the factor used to calculate your RMD, and probably a lot of you are familiar with this, so that again, you die basically cashing the last check out of your IRA. And of course, this is based on actuarial calculations. But what I've calculated is that this particular method allows you to keep your principal intact until your early or mid 80s, if all you're doing is taking your RMDs, and then you'll have a slow decline into the mid and late 90s under the IRS tables. So to recap where we're going, we want the potential for 9 to 10% returns annualized, right? Not every year, but over time. Total returns then are composed of current yield and price appreciation. The current yield is 7.8%. What drives any price appreciation? And we're looking at a couple percentage points in addition to the total return. These will be from dividend raises and climb towards net asset value, both of which define. I would first like to say, if this is so great, it sounds like rainbows and unicorns forever. Why isn't everyone doing it? Especially since I'm going to add that there are 3 bonuses. It's resistant to recessions, resistant to trade wars, and you can pretty much ignore the Federal Reserve, the overall market, and fear. So that's pretty much promising blue skies, rainbows, and unicorns, and we'll get into how that works. The first reason that not everybody's doing this is that liquidity is a limitation. If you're at Wells Fargo, or if you are Wells Fargo, you have $1.6 trillion in individual money to manage worldwide. Some of you may have gone into a Wells Fargo office or Citibank or Merrill Lynch, Morgan Stanley, and sat down, and the advisor will hand you a number of model portfolios, right? Sort of balanced, international, growth in income, equity income, and these all sound wonderful, maybe even aggressive. But if you look at them, you'll find that there'll be a few stocks that vary, but a goodly number, and I know because I've looked at these, are the same stocks. Big names. They somehow manage to cross categories. Well, why is that? If you're managing $1.6 trillion, there's not a whole lot of securities that you can buy without affecting the price detrimentally. This is very simple concept. Stock prices are set by supply and demand. Everybody wants to buy. Not as many people want to sell. The price goes through the roof. Those of you who are familiar with squeezes, that's why we see prices jump in those situations. Everybody wants to buy. Nobody wants to sell. And so the big elephant here, those of you who follow William O'Neill will know the example of the elephant in the bathtub. The big elephant is the big institution. The tub is the stock market. The liquidity for the stock is the water. Obviously, the big elephant, mom or dad, can't get in the tub without sliding price all over the place. The little elephant, however, can. And let's take a little elephant as maybe a $10 billion stock or company, and its liquidity is 160th of 1.6 trillion. The little elephant can get in it without sloshing the price around too much. Notice the stuffed animal elephant on the floor. It has significance. It is simply cute. Now, another key to this strategy is you get a small annual raise for some inflation protection. It's a real benefit. Now, none of us is, well, most of us probably have not held Coke since 1987, nor would we necessarily plan to hold an investment for 33 years, because that depends on when we start and how long. But through 2018, Warren Buffett's investment in Coke, the 2% dividend, it was paying 2% at investment, and it's risen annually since then, became a 64% yield in 2018, 39% according to this chart calculation through about 2012. So on your cost basis, you would be getting a 64% on your purchase. Small annual raise, which really adds up, compounds over time. This also gives us potential upside in that when dividends rise, the stock price follows. How does that work? Here we have a real estate investment that I view as recession resistant and very solidly managed. Medical Properties Trust. Medical Properties owns hospital buildings and leases them to hospitals. Here you see its price up and down the blue line since late 2013, and the orange line, the progress of its dividend over time. It's a pretty steady 25% hike over that period of time. Now you'll see as the stock price exceeds the progress of the dividend acts like a magnet, pulling it back to trend. In 2016, when the price falls below the dividend line, the dividend acts as a magnet, pulling it back to trend. Stock prices never proceed in a straight, even line. So we get the volatility, of course, but as you see, over time, price tends to follow dividend. So we get a little bit of dividend hike, we get a little bit of price hike with it. This is in addition, of course, to the high dividend that we want to receive. All right. My PowerPoint editor put in the term clickbait there, but I think it's pretty witty. What's the best stock category since the 1960s? I bet some of you are thinking, if we were in a room together, I'd be calling on you, seeking maximum embarrassment, when you would say something like tech or pharma. And actually, the best sector of the market since the 1960s has been real estate investment trusts, or REITs. Now, I have to qualify this. That's through 2019. It was 11 to 12% annualized, you see over on the right, versus 8 to 9% for the S&P. And that 2 to 3 percentage points a year really becomes significant when it compounds. Now, I would expect that this year, we would see better performance from the S&P versus REITs. How that would affect overall annualized, I would imagine, be very small, unless, of course, you started this year. But I will explain how that works near the end when I get more into risks and what I think the outlook for REITs are. A REIT is a real estate investment trust. It means it owns real estate, collects the rents, and sends those checks to us in the form of dividend payments. It's an IRS-favored business type, where as long as the REIT pays out 90% of its net income in a year, it doesn't pay taxes at the corporate level. So this eliminates the double taxation of dividends. The bane of our existence, or the bane of existence for most dividend collectors. The REIT collects the checks and pays us. Now, not all REITs are created equal. Some are better than others. And the other category, the closed-end bond funds, we favor certain categories over others as well. To diversify in our high-yield asset classes for your usual diversification region. So for today, let's consider that we have 7 buckets. We have a few more, but these are representative. And I would like to give some examples from each and explain what each is and why and how we diversify among them. The first is recession-proof REITs. Now, but I think that we can say with a reasonable amount of certainty that hospital REITs like Medical Properties Trust and skilled nursing facility and long-term care, such as Omega Healthcare, which I'm about to show you, offer certain recession-proof elements. It's not like we're talking about retail, which certainly has, or other local areas. The average yield of the REITs we favor in this sector is about 6.7%. The example that I provide is Omega Healthcare Trust, 8.1% current yield. It's been showing about 4.8% annualized dividend growth, and that's including the last 12 months. And so provided sooner or later price follows dividend, we would expect to see a range of 12.9% annual total return. Point out the liquidity issue here. Its daily liquidity is $70 million. It has a $7.4 billion market cap, which means it's by no means a penny stock or even tiny, but for a Wells Fargo, it's just not possible to have more than a smattering of client accounts in. But wait, you're thinking, Tom, what about, long-term care and COVID? Wait a minute. I thought nursing homes, long-term care facilities were among the most hard hit. Interestingly, we have not seen this with Omega, whose tenants, because remember, they don't run the facilities, they rent the facilities. So even though their rents depend on the health of their tenants, are the ones managing the risk. And so far, and through quite a difficult time, and when other long-term care facilities and so on have not done well, Omega has done extremely well. And this is consistent with what I understand and believe their management quality to be. Mortgage REITs. Now, if I were, I don't know, sort of a sneaky presenter, I would put them last, maybe out of the way, maybe hope you're kind of tired by then, because they do represent a fair amount of risk. Now, when I say risk, I mean volatility. Most people think, when they think risk, they think volatility too. They don't want a whole lot of it. Mortgage REITs are very volatile. That's the price we pay for the high yield on average. Mortgage REITs, they don't own physical real estate like the rest of the REITs we're talking about. Buckets of mortgages. They buy mortgages from mortgage providers, they get them at a discount, and they collect the mortgage payments and pay them to us. And this can be a very tricky area. We want REITs, mortgage REITs, that have all or a high percentage of the mortgages they buy to be agency REITs, which means that they are guaranteed by the federal agencies, Fannie Mae, Freddie Mac, and so on. We can get higher income for non-agency mortgages, but you're a little more exposed to the financial health of those mortgage companies. So we want to keep those things in mind and only own, keep the percentage that we own manageable. An example here is Arbor Realty Trust. Did quite well, has done quite well through COVID. All the mortgage REITs, as you may expect, got hammered in March because remember what it felt like. People felt like no one was ever going to make another mortgage payment. Seriously. No tenant was ever going to make another payment. No one was going to be able to afford an apartment. And those risks certainly remain. But what we got was an unprecedented and, in my view, necessary injection and stimulus by the Fed and Treasury. Remember, the lesson we learned from 1929 was that people talk about the Smith-Hawley tariffs and all that being a factor. I would imagine it's not just Milton Friedman, but the informed opinion today is that the Fed did not open the taps. And because it did not open the taps, we had massive deflationary pressures. Everyone was saving, nobody had any money, prices went down, nobody had any jobs, and deflation, which is the monster, right? Because you can't make people spend. You can certainly tamp down inflation, but deflation was the monster, and everybody thought we were done for. Then we got some stimulus, and we got round two. No matter. Arbor Realty Trust has a 10.9% current yield. It raised its dividend in the last 5 months. It has about a 3.5% average growth rate. I'm using a smaller one. And that would amount to, with the price increasing, about 14.4% annually. Its liquidity is 27 million a day, $1.2 billion market cap. So a bit on the small side. I'm teasing you a little bit, but I'll show you later how Arbor told us and kept us from freaking out in March and staying the course. Apart from the fact that I have ice water in my veins. The next category of REITs is what I call opportunity REITs. And as a value investor at heart, I'm always looking for corners of the market that have been irrationally sold off. The best example of this that I can think of, or most vivid, is the oil spill, the Macondo oil spill in the Gulf around 2010, when every offshore oil driller's stock was sold off massively, 50, 60, 7%, whether they were the company, Transocean, or not. And that was a really good time to take advantage of sound investing principles and say, look, these companies have modern fleets. They're not at risk in the same way than the old Transocean rig, the Deepwater Horizon. It was a good time to pick up offshore drillers. It was not a good time to own them forever, however. So these are opportunistic investments. And an example that I would use in the REIT space today is Simon Property Group. And you might say, Tom, luxury malls? Are you kidding me? Well, I certainly wouldn't be buying strip malls. You and I have certainly passed enough of these in small towns, well, even in cities, where it seems to me like half the places are empty and the other half are not thriving big ticket businesses, a lot of rents. Simon Property Group is the largest REIT, has a $19 billion market cap, $516 million daily liquidity. It's paying 8.4% after a dividend cut. It's 60% off its 52-week high, giving it 150% upside to its high. 52-week highs don't really mean a whole lot. It's that, in my view, the 52-week high for Simon is pretty indicative of its normalized, in a normal environment, whatever that is right now, right? Valuation and performance. Now, why would we own a luxury mall? Well, if anything's going to survive, I would submit it's luxury, because this is the hardest thing to commoditize and sell on Amazon. It also has massive balance sheet liquidity. Simon can basically continue for years without a single rent payment. And as it happens, that's not happening. All 204 of its US luxury malls are open. There's a massive cash and credit cushion protecting it, and the downside arguably has been wrung out of it. It also has international diversification, say that a few times, which allows it to have some protection both on currencies and on things like the prevalence of disease in their locations. I don't view Simon necessarily as a lifetime hold, but I view it as opportunistic and that it could offer us some pretty explosive returns. Could. I always have to qualify as a value investor while we wait. But meanwhile, it seems to me the downside is very low, particularly given the value of its properties versus its debt. Now, we move from REITs to the bond part of the portfolio. Bonds are about, I would say, 45%, 40%. REITs are about 40 to 45%, and high yield stocks 10 to 20%. Now, how do we do bonds? We don't buy individual bonds. We buy managers. We buy people like Gondlach, who is the bond god, double line security, double line bond fund. People like him have managed funds 10, 20 years longer in all kinds of interest rate environments. So that's what we want. We want people who are good enough to manage things like duration, location, currency risk, and so on for us, and track records that are readily available. By the way, I should add, all the numbers that I am interest paid, dividends paid, are net of the management fees. Normally, I'm a Vanguard guy. I don't want to pay any kind of fees, right? But that's for passive investing. If we want higher rates, we're going to have to get actively managed, and we're going to have to pay for people who are good. So they might charge a couple of percentage points, but all the figures I'm giving you are net of that. That's what you actually pocket. Closed-end funds are mutual funds that trade like a stock. They're actively managed, unlike most ETFs, which are mutual funds that trade like stocks, but they're indexy. They're not actively managed for the most part. Fixed number of shares. Uses manageable debt to increase returns. We only want the ones with manageable debt. Let's say 20 to 35%. That means that if the value of their assets declines, they're still unlikely to get margin calls or trouble from their lenders, asking them to put up additional collateral. So if I can't repeat this enough, it's all about the manager. And they're generally too small for institutions. Prior to what we know as open-end mutual funds today, there were only closed-end funds. The open-ended or mutual fund that creates shares, depending on how much money is put into it, is a recent invention, recent historically, late 1940s. All right, what is discount to net asset value? When I talk about buying closed-end funds at below the value of their assets, you might say, how is that possible, Tom? For an open-ended mutual fund, you're never paying more or less than the value of the assets. You wait until the end of the day, net asset value is calculated, and shares are bought and sold. Whatever the value of its portfolio is, divided by the number of shares, that's the price. Net asset value is easy. It's your assets minus debt. And that's simple, you know, your household balance sheet. You know what you have, you know what you owe, you know what your net asset value is. Some of it's liquid, some of it's not so liquid, which will become important. Now, what is a discount to NAV? Net asset value, I'll call NAV. Here we see a window, a picture I took off the web, thinking myself incredibly clever. However, I think my future as a designer is in doubt. Let's take the top of the window frame as net asset value, and let's say for this closed-end bond fund, it's $12. If we took the value of all the bonds it owns, subtracted the debt, the leverage it used to pay for it, divided by the number of shares, let's say it's $12. However, it's selling for $10.50. The window is open, pulled down a bit. The space between is the discount. Let me move back to that for a second. Well, I guess I can't. There we go. So if the window were to close upwards, that is the metaphor for closing the discount. And that would mean that the current price would rise and we would see capital appreciation. Here's another way of looking at it. Your NAV, price, and the discount to NAV. Now, how do you get a discount to NAV? How could you ever pay, let's say the stock is, in that case, the stock of the closed-end fund is selling for $10.50 and the NAV is $12. Wouldn't everybody jump on that discount? How can that happen? Folks, I'm here to tell you, the efficient markets fairy is dead. And anyone who still believes in it believes in rainbows and unicorns. Let's go back to that example. But discounts to NAV happen. Just as stocks are sold off for irrational reasons, for fear, like Arbor Realty during the crisis in March, or the first sort of fears of the financial devastation that would happen if stimulus had not been given, let's say, provided. It happens. And I'll show you it does. I really recommend this book. It's a page turner, though perhaps only for geeks like me. Justin Fox, a wonderful financial journalist, worked for the Harvard Business Review, now writes for Bloomberg, The Myth of the Rational Market. And if you still believe in the rational market by the end of that, I think you might be denying objective reality. A number of studies shown that if you buy the discounts, it leads to consistently higher than market total returns. And this is one particular study that for some reason I felt would give me, I don't know, credibility if I included lots of fine print in a slide. I think all that does is make me wonder where my glasses are. With discount, we see the magnet waiting to pull price up, to pull price up to dividend growth and have them follow each other. So here we have the net asset value in orange and the price of the Cohen and Steers Infrastructure Fund, a closed-end fund investing in securities of infrastructure companies. And the blue line is the price, and it is pulled up as if by a magnet to the net asset value. Now, of course, this is a handy example. What presenter doesn't show good examples? Sometimes closed-end bond funds have discounts that persist. And that's easy for us to find on cefconnect.com, where we can see historical net asset value. So in that case, we want to buy at a greater discount than what is historic. Some funds sell at discounts due to their perceived risk. Fine. We just make sure we buy at a discount that's greater than average. On average, though, we will see that the discount closes. If it closes from a greater than usual discount, it will close to a normal discount. So let's shift to go anywhere bond funds. And these are simply ones that have a mandate to go anywhere. Surprise, surprise. Global bonds, US bonds, emerging market, not so emerging market, and we like that for diversification. And in the ones that we include in a group that we believe are good here, the average yield is about 8.1%. A good example, in my opinion, is the Aberdeen Asia Pacific Income Fund, or FACS. It has an 8% and a 13% discount to NAV. Its average discount is in mid-single digits. So it tends to be selling for a 6 to 7% discount. So we have a double discount there, and we have 6-7% upside built in. Liquidity, daily liquidity, 3.4 million. On the small side, but not for you or for me or my clients. I suppose if someday I'm managing $20 billion, which will be in my incarnation, that might be an issue, but today it's not. Here is an indication of some of the bond yields, some of the bond types. We have Indonesia, which surprisingly has a pretty good credit rating, and Australia and Queensland. So it does say Asia and let me just see here, Asia Pacific, but a really good proportion is Australia, balancing out perhaps some of the higher risk of where you also get higher yields. Excellent management over decades has managed this risk extremely well. And we know that a lot of those countries have had credit turmoil. And yet this closed-end bond fund has been very consistent throughout. Let's move to a category that I think is probably very interesting to investors, which is interest rate sensitive bonds. What happens when bond yield prices fall? When bond yields fall, prices rise. So we need managers. We want, for a certain part of our portfolio, funds that are perhaps floating rate and managed to do better in one direction or the other. Now, if any of us could what the consistent direction of interest rates would be, we would all be, I don't know, depending on our preference, we would all be in the Caribbean drinking umbrella drinks, not going to this presentation. But nobody ever seems to be able to predict the direction of interest rates with any real dependability. However, we can say when trends start, we can get a sense from the Federal Reserve where that is going. December 2018, we might have thought that the trend was towards tightening. Remember, the bottom fell out of the stock market for 2 weeks. Next month, Jay Powell turns things around and says, no, we're not going to do that. Stock market goes on a tear. So we know that it's very much we need a trend because things can give us whiplash in a very short period of time. I think fund in particular, the one that I'm going to choose, it shows a lot of points about when we want to own these. We want to own floating rate funds, and they tend to fall into two categories. Ones that are more favorable for rising rate environments, and ones that are more favorable for declining rate environments. Now, investors don't always distinguish between the two. And in March, what would you expect? Well, you would think that everybody who owned floating rate funds that would profit from rising rates would flee, because when you face the deflationary threat that we certainly saw at the beginning of COVID, and we'll see, I think, as soon as any stimulus wears off, is that people shunned anything that had to do with rising rates favorably. So a fund like Floating Rate Opportunities Fund that tends to do better in rising rate environments sold off massively. It's selling today for a 36% discount to NAV and an 11.5% current yield. Low liquidity, which we like. Now, look at this. Before COVID, we have some discount between NAV and the price. And that's about the historical average. Let's say that's about 10-ish%. And then, of course, with COVID, what happens? The bottom drops out. The distance between NAV and price widens, yawns. Today, that discount is 36%. And versus on average a 5 to 10% discount, if you look, which cefconnect.com will show us, cefconnect.com, this is just crazy. And look what happened. NAV, yeah, it declined from 14-ish to 12-ish, about 15%, and it has since inched back up. Remember, NAV is very good for these, very reliable for these funds, because it takes the market value of the security, of the bonds it holds, takes the prices every day, and gives you the actual market price. So now we have maybe an 8%-ish discount to, excuse me, an 8% drop of NAV from its high pre-COVID. And then we have this yawning gap that starts because everybody dumped anything interest rate sensitive. This is where fear came a tremendous opportunity. Hardly any downside. Now, I won't say none because you can never say none. But here we have, and how much can rates drop from here? I don't know. Can they go negative? Sure. But it would seem to make sense to me in a diversified approach that you would want to own some percentage of your portfolio in high yield in a fund that will show outsized profits in a environment. They really have almost nowhere to go but up. And of course, we have secure, boring bonds. Oh, by the way, I'd like to mention, and I have stressed, but in the case of interest sensitive and opportunistic REITs, we really are active managers. Buying discounts, selling at premiums. Who wants to own a closed-end fund that's selling for more than the value of its assets? I don't know about that. I suppose people pay more than the value of higher a growth rate for tech companies buying years of earnings ahead. But for closed-end bond funds, I don't really want to pay a premium. It really limits, it increases downside risk, I should say. So we are active managers, right? We're taking advantage of though there are some things we will just own indefinitely. Secure boring bonds. This is one example of something we might hold indefinitely. Municipal bonds. This, of course, is appropriate for taxable accounts, not for IRAs, because you don't get the tax advantage in an IRA because bonds are non-taxable. This is familiar to many of you. If you're getting a 4.7 yield, perhaps, on municipal bond funds such as NVG, sponsored by Nuveen, the municipal bond behemoth, your tax effective yield is 8%. It's currently selling for a 6.7% discount to NAV. Liquidity, again, is wonderful for us, not so great for the big guns. And this shows a way to calculate. If you go to Nuveen's site, you can play with this calculator all you want. Put actual yield, federal tax rate, and it comes up with your effective yield. Our third investment type is high yield stocks. I was just checking the time, not doing too badly, I must say. High yield stocks, third investment type. We're looking for stocks that yield at least 6%, preferably 7% or more. We want consistent dividend because we want to get the little bit of price increase we'll get from the dividend magnet. We want substantial stock buybacks. Why do we want that? This was brilliant. So I'm early in my professional career as an analyst, not all the decades I was doing it for fun. Well, I'm not saying it's not for fun. Let's just say when I wasn't doing it professionally. And a friend who now manages tons of money sat me down and said, Tom, he showed me the effect of when a company buys back, a dividend-paying company buys back a share of its stock. And what it does is let's say I'm a company, I'm paying 6% dividend every year. So I buy back shares. Every share I buy back, I'm not paying at 6%, whatever dollar amount it is on that share till the end of time. It frees up more cash for me to pay other people. So the power of buybacks creates a kind of virtuous cash cycle. Of course, it assumes that the company continues to create cash and that they're buying at a discount. You don't want tech companies going out there buying back shares to mask their options grants. We really want them to reduce their overall share count. So buybacks are good. I know there's a big debate. Good buybacks and bad buybacks, and we're looking for the good ones. Of course, we want seasoned management that can manage our dividends and our business and our cash flow over very long periods of time. These are usually considered to be what are called dividend royalty, dividend aristocrats. They have raised dividends unendingly for long periods of time. Of course, it takes more than that. You have to look at their cash flow growth and their shows how much of it they're paying out versus how much they need to grow their business. Are they borrowing from the future to pay dividends today? We certainly don't want that because it puts the dividend at risk. The stocks in that category that we're looking at currently are paying a pretty high yield. I wouldn't expect that to stay so high for new investors down the road when their stock prices normalize.
Hey, Tom, are you still there? Your screen seems to be frozen. We can't hear you. Tom? Hang on, folks. We'll get Tom back, hopefully. But if you've got questions, put them in the chat box. We'll get to them at the end. Tom, if you can hear me, we can't hear you and we can't see you. You're gone. Here we are. Tom, you're muted. Tom, we can see you, but we can't hear you.
Okay, what happened? Now we're good, right?
Yes, you're back.
Okay,
Thank you.
yes, I'm back.
You know, there were some blank spots. You must, if you're on a wireless connection, maybe it's because of the problem.
Yep, every now and then, Wi-Fi will say I'm unstable, or rather my Wi-Fi is unstable. Now, I'm getting all the faces over on the right again. So people are seeing...
The few that are showing themselves, yeah. Okay.
All right, we'll go back there. Okay.
I can see your screen. So
all right. And you can see me.
And I can see you.
Good, which is the most important thing, right? Okay. It's very interesting. One of the reasons that this won't show up on a lot of dividend screens is that it got hit in 2008, 2009, and the FDIC put it under some restrictions. Now that's 11 years ago. When it did not get taken over, and when it came out, it was under standards. Now, this is a family local bank. It does issue mortgages nationally, but it's in Cleveland. It's in what used to be a majorly Slavic neighborhood, and it's been owned and run by a family for a very long time. They got a little hit in the mortgage crisis, as did practically every bank that issues a mortgage, but they came out of it alive and fine and have been extra conservative the last years, and when they got permission to start issuing dividends and buying back stock again, they have maintained incredible capital ratios. All right, let's see what happens here. All right, there we go. Now, let's talk about volatility and risks, and this is the last part of the presentation. And I've used up an hour. Well, let's see, we started a bit after the introductions. Anyway, I hope you'll stick with me. My father, who was... make a note.
Let me interrupt. We've got till 11 o'clock. We schedule this for 2 hours.
Oh, excellent. All right.
You've got lots of time and you're gathering up some questions over here.
Okay, very good.
I've interrupted you. Think about, and you can answer it later. People want to know if the slides will be available.
Yes, I typically provide the file to the group, and I'm happy to have you distribute it.
Well, if you just...
Yeah, I should have said that at the beginning. Oh, I should have said that at the beginning. All of you who've been taking notes, you can drop your pens because you will get this.
And what I'll do is what I've done in the past is that I will post, if it's all right with you, Tom, the presentation. For example, our last speaker, Kevin Grogan, his presentation is on the Roberts Financial Management site where anybody can access it that wants to.
Yes, that happens routinely with my AAII presentations, and I'm happy to do so.
So what I'll do is I'll move this thing here, folks, to the past events, and I'll add his slides and eventually its minutes. All right, back to you, Tom. Sorry.
So now we enter the volatility and risk section. I've alluded to some of these earlier, but as my father was fond of reminding me, there's no such thing as a free lunch. I had the benefit of parents of both ends of the political spectrum. My father was a Goldwater Republican, and my mother was a Manhattan Democratic liberal. So I like to think that I had the best. I had the best of both, and I think I've ended up somewhere in the middle. But my dad was fond of saying, "You don't get something for nothing." He was born in 14, was working through the Depression, and I think never got over the idea that the other shoe could potentially drop at any time. So we have to look at volatility and risks. And I think what we can say, enough about my dad, right? Though he did start me investing in 1968 and was a great force in encouraging that interest. So closed-end funds will roll along, delivering their 6%-ish, and actually 6, 7, and 8%-ish. I don't only said 6. And every now and then there'll be a big volatility event. And this will be why it's important not to own something with more than, I don't know, 20, 30, 35% leverage, except in certain cases. There's one fund we own with more because the manager has had decades of managing that, and we believe that he knows how to handle leverage. And in that case, the value of assets will decline, and it's possible that lenders will demand higher collateral or more collateral, which means basically you have to sell some bonds that are selling at low prices at a bad time, reverse dollar cost averaging. None of our CEFs had a problem with that, and it's one of the reasons why we want long-term management, so we can see how they managed through prior financial crunches. Because when things are tough, everybody, and they're going to take it from wherever they can get it, and lenders might very well take it from the CEFs. So that's another reason we really want to see. And so every now and then it'll happen. The CEFs will get hammered below their discount. They're hammered below their net asset value. And that's also a good time to pick up deals such as with the Highland floating rate income fund that I noted. Same happens with REITs. For all sorts of different reasons, it may get hammered. Who could have foreseen that commercial and rental real estate would have been under such pressure? And not all of it, of course, but some. I would say that all disruptions are unforeseen. Everybody says, well, I didn't see it coming. Well, the odds have favored a big viral event like we're experiencing for a long time. We just don't know when. We have a banking crisis about every 20 years. Is it going to be 20 years? No, we don't know when. So we try to manage the portfolio for all sorts of situations. And the key of any investing strategy is, can you stick with it? I mean, I lay this out for clients and I say, okay, in December 2018, this was less volatile than the market. it performed much better on a price basis than the market. But in March and April, it performed much worse than the market. And yet, of course, the dividend yields have remained fairly strong, hence safe, even in a terrible environment. And so, if you can't stick with the strategy, what you're doing is you're selling at times of high panic. And the point of this, if I could drive home one point from this presentation, it's yields are as safe as you can get for high yield, but you will have volatility, particularly at extremes. Let's look for illustration at this chart. I'm hoping that you have a big enough screen. Perhaps you can zoom in. This shows the performance or the relative performance of 10 asset classes annually for the 2000 through 2019. And my purpose in showing this slide is to show how much different asset classes vary in performance year to year. I consider the calendar year to be meaningless because I'm a long-term investor. But the world operates by calendar years, and so we can learn from looking at it. I'll point out the colors because people need that given the small size of print. I'm going to concentrate on high yield, just sort of orangey yellow, real estate, which is teal, and large cap, which is blue, but also discuss some of the other areas. High yield and real estate, because those are the two categories in the how to retire on dividends approach. And large cap, even though, what I think is not be what other people think of as large cap tends to be the market index, what drive the market indexes, which is what people see on the news and which drives the emotion people have about the stock market. Now, if we look at 2000 as an example, the top performing asset class for the year was real estate funds, which for REITs at 13.2%. The teal box at the top for 2000 of that column. Real estate funds, 13.2%. We go down the column, US fixed income, cash and equivalents, the chartreuse hedge funds, 4.85, just for illustration. Small cap stocks, off 3%. That is non-US fixed income, off 4%. Now high yield, off 6%, and then large caps, off 9%. And developing country, that is ex-US stocks, off 14%. So here, the difference between real estate and large cap was about 22 percentage points. A big variability or Now, if you look at this chart, and if your eyes can pick out the bright orange, in 2001, the bright orange cell is 7 cells down, emerging markets. Now I'm picking out emerging markets because now look what happens. -3%, -6, and then 5 years where it occupies the top spots. And this is dollar weighted, right? So it takes account of currency fluctuation. 2003, emerging markets is the top. 2004, 26%. 2005, 34%. 2006, 2007. And then what happens? 2008, the worst performing asset class, off 53%. What do most people do? Most people, after the first year, let's say 2004, think, oh, I'm going to move my 401k to the emerging markets fund that's in what my 401k plan provider, and then 25%, and they think, oh, that's so great. And then everyone who didn't get the 55 and the 25, they go, okay, I don't want to be left out. 2005, they get the 34%. Well, now anybody who's straggling, 32%, or they jump in, they don't want to miss the ride, they get 32%. And finally, well, no, not finally. A few more stragglers pull in 2007. They take that emerging markets fund and they go, oh, I'm so smart, 39%. And then what happens in 2008? Off 53%. Now and then up. But you understand, when you've lost 53% of all those gains in 2003 to 2007, it's taken a lot more than 79% to recoup. And then you see a lot of variability for the orange cell through 2019. Never has that kind of track record again. By 2008, absolutely every person who's left is investing heavily in emerging markets just in time for 53%. Now, I would submit that the emerging markets of the last 7 to 10 years has been large cap, starting in 2012. No big deal for large cap before. Middle 2010, middle 2009, off 37 in 2008. Yes, we remember that. Middle, though middle was pretty good in 2003. And 3 terrible years, 2000 to 2002, which we all remember. But starting in 2012, with 1 year exception, we see that large caps have dominated. And this is primarily due to the growth of big stocks in the S&P 500, Google, Facebook, though the Facebook's IPO wasn't in 2012, it was a little later, Amazon, Apple, and Microsoft. Their growth in stock price has been about 20% or more, well, depending on the particular period, but overall in large cap stocks. If you owned all the rest of them, if you owned an S&P 500 equal weighted fund, nothing like this. So that's an important thing to recall. And also, when large caps have done so well for so long, not predicting what's going to happen, but the longer something outperforms, what we've seen is it eventually comes back to trend. The longer it underperforms, again, provided that the selections are made sensibly, and in the case of these indexes, that takes out a lot of the selection bias. I would say large caps are due for a fall at some point. And you can see this with almost any colored cell or asset class throughout. In 2006, 7, 8, up at the top, it's not visible, real estate was the best performing category. I'm wondering if that's, I can move Bob there. There. Real estate in 2018 outperformed large caps by about 12 percentage points. Large caps in 2019 outperformed by about 25, 26 percentage points. So it just depends on your particular year. So asset classes outperform until they don't. So let's look at, in our case, REITs and closed-end bond funds. What are the factors? Leverage or debt. We don't want to get stuck with our companies getting margin calls, of course. And I mean, it's so extreme, it's never really a consideration until, of course, liquidity dries up, and then it's really a consideration. So you need liquidity. You need the other kind, which is balance sheet liquidity, cash and credit lines to get through it. And then, of course, fear of dividend cuts, real or imagined, can be a strong risk as well. These are risks were huge in 2020 and COVID. I don't know why I have the same slide. It's a mystery. And let's take a look again at Arbor Realty, the mortgage REIT that got through it with flying colors. Its stock price got hammered, of course. We got a press release, showed no red flags. Liquidity, the company said, of course we have enough. And not only, well, there was a big fear of dividend cut. The company maintained and raised their dividend in this. So the profits kept flowing. Now, any press release, any company can say anything it wants. And we have no reason to trust it. So when I say no red flags, it's a very lengthy release with a lot of numbers, a lot of indications specifically about their leverage, what their relations were with their lenders. And they, especially liquidity, had enough cash and credit on hand to basically weather a massive drop in the value of the mortgages they owned. Any mortgage REIT that didn't, it was pretty funny. So the mortgage REITs were all competing to put out these kinds of press releases. So if your mortgage REIT wasn't doing it, it was a sell, guaranteed. One of the nice things about that is that it's led all these companies to be much more transparent, even more than they were in what they shared with us on a regular basis. So here's Arbor Realty's chart showing in the purple line its price, and as you can see, massively down, as everyone thought no one would make another mortgage payment. And then slowly back up, approaching closer and closer to its pre-crash price. And then the dividend hike at the beginning of July. And yet it's still 25% off its 52-week high. Fear still rules. Malls, shopping centers, office, and industrial REITs also engaged in proactive communication. We're now getting, it's fabulous. We're getting these monthly reports of what kind of rent their tenants paying, as in what percent of normal rent. Percent of tenants asking for forbearance, the status of negotiations. REITs that have been sold off dramatically are some of them as much as 99% of their normal rent. 1% for forbearance. Some of the shopping centers, it's as if nobody thinks anyone's going to buy groceries, and yet these grocery anchored shopping centers are doing quite well. People think, oh, in the era of Zoom, office tenants aren't going to pay their rents anymore. Now, personally, for clients, I own tiny percentage of any office real estate, and it's as part of another larger real estate investment trust. But even they are getting massive percentages of rents. And industrial, of course, doing very well, because that includes warehouses and things that Amazon is snapping up. So are they maintaining or cutting or suspending their dividend? Now, dividend cuts usually go with price drops. But we don't care with REITs because we want them to have enough cash. Why don't we care in the long run? If we're income investors, just listen. There's a REIT burden hand for income investors. They must pay 90% of net income to retain their IRS status, to retain the dividend exemption from taxes. So if they have net income for the year, they have to pay 90% of it. If they have suspended their dividend for 2 quarters, they will have to pay, in some cases, massive catch-up dividends at the end of the year. These will act as massive, I'm using that word a lot, but it can't be overemphasized, catalyst for stock price appreciation. Now, you understand, in the status for my clients, I don't own more than a couple where there's been a suspension or a dividend cut, and those are carefully selected for their liquidity and profitability, in some cases bought after the cuts in light of the catalyst that will presumably come at the end of the year when they're forced to catch up. So these are still profitable. They have net income. They've just been very careful to maintain their cash. Not very different from a lot of people who are not spending because the uncertainty makes them want to save their money. So I would say the bottom line is volatility is the rule, not the exception. Extreme volatility hits various sectors, including closed-end bond funds and REITs, without warning. When REITs were sold off in March, it didn't matter what REIT they were. Everybody just wanted out. And that's what happened. And it wasn't just REITs, of course. And then there's kind of what Ben Graham said, which was the stock market in a short term is a voting machine. People vote for what's popular, whom they're afraid of, whom they favor. And then the market is a weighing machine where relative quality does better over time. Everything got sold off in March, and we've seen the recovery in some sectors and not others of REITs and closed-end bond funds. And as my father said, there's no free lunch. Anything that sounds better than treasuries comes with volatility. I'm not talking about the risk of losing capital permanently. That's what risk is. I'm talking about normal stock volatility. And I have to give a plug for my clients here because I actually had 3 that were worried during all this that the volatility was more than they could handle. So either I had educated them successfully, or more likely they had more important things on their mind. But I would say that that this is a strategy that, except at the extremes, offers pretty good volatility for the returns, or pretty good returns for the volatility. And in extreme times, that's when the opportunities then the opportunities become available. So I'm not actually recommending that anybody do this with 100% of their money, but I think that it is an excellent part of the diversified approach and offers a lot of benefits for people who want a safe, relatively safe, high yield, and who can stomach, volatility that may or may not be in line with the stock market. Oh, and when I say that, remember the different categories, large cap, high yield, and so on. These are not correlated with the overall stock market. They will behave differently. Where do we find these? Well, as you can see, it is work. If there were an easy screen, if we could just screen for them, we wouldn't have the opportunity. But there are 2 ways that I think are very helpful. CEF Connect will give you all the information on any CEF, its discount, its current leverage, its current debt ratio, what it's paying out in terms of yield, historical information, a very helpful site. And normally, I'm not a fan of newsletters or online research. I certainly do it. I mean, I do all my research myself, but I would recommend there are some extraordinary REIT analysts on Seeking Alpha. Be critical. Don't do everything they say. Pick apart what they're saying, but some of them really are extraordinary and do excellent work. And I'm going to leave you with that to find them, because I don't want to be responsible for your selections. But I think they're Brad Thomas. Oh, here I am going and doing it. Brad Thomas is a good one, and UC Escola, who's German, is a good one. But there are many. When we choose REITs, we want in-demand real estate, manageable leverage. We want internal management. We don't want some outside company managing it, so all they do is collect their fees. And we want inside ownership. We want management to eat their own cooking. That is, have skin in the game. They own the stock. They want it to do well. Choosing closed-end bond funds, we want above average dividend yield. We want to buy bonds that are somewhat lower than the best, but not too low. AAA rated bonds, you never get a deal. And this is where we want managers who can pick out the bond deals. Insider ownership where it exists, and we always want a discount to NAV. It pays to be a smaller investor. I'd like to point out that the book that this is based on is available just for you on howtoretireondividends.com at a 20% discount, 25% discount to Amazon, and that includes shipping. That's at howtoretireondividends.com. It's a good book. And here's my contact information. I'd be happy to speak with you. And you've been a very attentive audience. I can't see when any of you have gone off to get a cup of coffee or anything, but I appreciate your time and attention. And I believe we are approaching the Q&A.
Thank you. Let's see in your slides. Let's dispense with this one quickly and leave that slide up there for now so people can copy that down. They all say confidential. Before you send them to me, would you take that off? I don't want to publish anything on our website that says confidential.
I will try.
At the bottom down here, it's in the footer.
I understand. I will try to remove it.
Let's see a couple of general housekeeping things. The slides, people ask again how they get to the slides. Roberts Financial Management. I put it in the chat box so you can go in there and find it. Past events. There's also past events up here at the top. Either way, get you to this page and the presentation and the minutes. Our past meetings are there, as Tom's will be coming up. It says Roberts General Services, but Roberts Financial Management will take you to this page. Okay, and there's the, all right, so that, let's see, some of the other questions. Tom, can you see the chat box?
I don't quite know what happened here.
Well, let's see. Let's just go through the questions then. We've got a few minutes.
I no longer can see the chat box. So why don't you act as the moderator?
All right. That's what I was about to do. One of the questions was, well, I don't understand the background for this. If these are thinly traded bonds, are the prices really set each day to determine the net asset value? It's gone back to, that was early on.
Yeah. Well, bonds in general have less liquidity. The question is an excellent question. Bonds in general have less liquidity. The bond market itself is rather, to you and me, somewhat opaque, which is why we hire the managers of the funds. Thinly traded, all I know is the accounting rules that require mark-to-market accounting. If something is so thinly traded as to not provide a reliable price, that becomes something like a level 3 asset, I believe. I'm sure there are accountants in the audience who know this better than I do, but I don't think that then they would be allowed to provide a NAV. This stuff is all very highly regulated. I'm not talking about most of these funds, I'm not talking about really thin. I would say for the bonds, it's the bond funds that have less liquidity, but I would not say that the bonds do. And that's certainly not something I'm an expert on, but what I am an expert on is that if you don't do accurate mark-to-market accounting, you have bigger trouble.
Okay, and there's a question on the minimum account size. I would suggest that whoever asked that question, you contact Tom directly on that.
Yes, and yeah, that would be a good thing to do. And then I would tell you $100,000.
All right. So there's your answer. That's a lot of questions on is it recording and how do you find the slides? I've answered that in the chat box. What's the main difference between CEFs and ETFs?
Another excellent question. ETFs are mutual funds that trade like stocks. Closed-end bond funds are mutual funds that trade like stocks. The difference is that closed-end funds are actively managed. Individual securities, individual REITs and bonds and various things, individual bonds in this case, are analyzed specifically, individually, and selected. With very few exceptions, very, very few, a fraction, ETFs are indexed. They're passive instruments.
Isn't there a liquidity issue on closed-end funds as well? I mean, they're closed end.
Well, no, what that means, what closed end means is that I think there are two issues there. A closed end fund can have a lot of liquidity or a little. It depends on how much on average is dollar value is traded on a daily basis. It has nothing to do with it being a closed end fund or not. The fact that it's a closed end fund is, that it has limited shares is relevant to that it can sell at a discount. An open-ended mutual fund, which is the mutual funds that we are most used to, we're most familiar with, can never sell at a discount because its NAV is set daily and all trades are at that NAV at the end of the market, after market close each day. Can never get a discount. With closed-end funds, because the shares are fixed, like with any other stock, though of course you can add, you can sell shares to raise money, which they do. But because of that, the market can sell it off like a stock and you can get a discount. Or you might have to pay a premium. It works both ways.
Right. Well, okay, we'll either follow-up questions. I have some follow-up questions to that, but that's getting off track. What has been the volatility rate as compared to the S&P over the years for your accounts?
If you look at that periodic table of asset classes, you'll get a pretty good indicator of volatility versus the S&P. If you look at the high yield, yellowy orange.
Can you just look back to that?
Oh, good idea.
There.
Yeah, I just want to get the one without all these little.
It turns out to be, there you go. Oh.
Yeah, okay. So if you look at the dark blue boxes and consider that to be the S&P, and you look at real estate, which is teal, and high yield, which is sort of, orangey yellow, you'll see that there is, in any year, quite a difference. So there's absolute volatility, that is how much something is bouncing around. And then there's, as the questioner asked, relative to the S&P. So here I would use large cap as a proxy for S&P. And you'll see that very, very rarely, in fact, if I look at this, only maybe in a couple instances are real estate funds and high yield right around large caps. Now, is this our performance? No. So for example, in 2008, or in 2009, let's take that, you see that real estate funds returned 4.4% versus the large cap at 31. The particular, and high yield about 14. For whatever reason, the particular high yield and funds and real estate funds that this strategy selected were up about 29%, so almost exactly the same as large caps. Just a number of factors that made it an unusual year. I would expect that this year, again, the yields will remain fairly consistent. They already have. I would imagine that the pricing this year will be substantially different from the S&P 500. But if we look at annualized returns, that's what I'm concerned about. And I'm also concerned, my main priority is producing income in excess of 4%.
Okay, you want to go back to your last slide so they can get your contact information? This is probably one that's best answered on a one-on-one basis. It's how many years before an investor plans to retire should they start move assets into income investments. Again, Tom, I'll leave that one up to you if you want to answer that. That's
Well, yeah, I mean, I actually think that that's I think that's a pretty good question. I mean,
all right.
what killed people in 2008 and 2009 and 2000 and 2002 was they extrapolated recent returns into the future when determining what their retirement nest egg was. So after 98, 99, early 2000, people would go, geez, look how much money I've got buying pets.com. Okay, that's a little unfair. And they would say, okay, now if I have this much money, how much income will it produce? And at that point, you could still get some income, decent income from treasuries and so on. Though that was because inflation was higher, right? There's nominal returns and inflation adjusted. So anyway, and then what happened from 2000 to 2002? All those portfolios collapsed. And suddenly people who'd been counting on, retiring at a certain point had a lot less. Same thing in 2008, 2009. What I recommend is that that this be part of an overall strategy that you move to in, let's say, 5 to 10 years before retirement. And I would say, make sure you're reinvesting all the dividends in something like this. It doesn't have to be this, but at the same time, you have some asset allocation where some asset allocation strategy for a part of your portfolio. So you get a bit of a balance. You maybe don't get all the extreme volatility that you might get in a COVID period or something like that. Not because it affects the income, but because I just think emotionally, people need to have some part of their money that's like a ballast and so on, so they don't change strategies at the worst possible time. But I would start moving. Oh, brings me back to another thing. Yeah, I don't want to. I mean, I could go on all afternoon about this, but I'm happy to discuss it individually. It's a big topic. Big topic.
Yeah, it is. There was a question again on how to get your book. I think the simple answer is it's on Amazon.
No. It's on Amazon, but you get 25% off Amazon if you go to howretireondividends.com.
There you go.
And we don't, why pay more? Isn't that the commercial you see for all your local stores?
Well, the person that asked that question, there you go. Let's see. With the ability to sustain high payout while not losing control over the principal, this is a very strong alternative to annuities in retirement. There's a question
Yes.
at the beginning of that. I guess that's a question.
Yeah, I think two of the worst products ever sold to investors really are annuities
Annuities.
and whole life insurance.
I agree. The fees on annuities are terrible.
Yeah. Now, and it's important to remember that financial advisors are primarily salespeople, and investment advisors are subject to the fiduciary standard, where we're fee only. Hey, look, I'm not saying holier than thou. I'm talking about regulatory rules. Investment advisors have to put client interest first, which you think everyone would have to. Financial advisors outside of IRAs are not required to put client interest first. They're only required to purchase suitable investments. Well, you can drive a truck through the definition or the window of suitability. And so financial advisors are always looking for products to sell. And I would have to say several times a year, I get people coming to me saying, Tom, I have these annuities. Can I get out of them and get more better returns from them? And depending on the annuity, that is possible and how much has been put in. But it's and I'm not, and you can go to anybody to help you with that or do it yourself. But people are getting 1% and 2% from their annuities, and that's, That means they're selling their other investments if they're on the 4% rule to to make up that other 3%. So,
It's a good deal for the person that sells the annuity.
yeah, it's like insurance. They keep getting a cut every month.
That's right. They get an income every year. Let's see, there was another one here. Are we able to invest in closed-end funds? I thought they were closed to investors. You might explain that again. That's not what closed means.
Yeah, no, closed-end just means there's a limited number of shares. Open mutual funds are open-ended funds. There's an unlimited number of shares, but you can absolutely buy them just like a stock. You put a ticker in on your discount broker, online discount broker, and it'll pop up like any other stock.
Okay, and that seems to be the end of the questions. Any other, anybody want to type something in the chat box there for a minute?
We still have over 100 people. Amazing.
Yeah, we do. That's good attendance today. And thank you.
Amazing on a Saturday. Don't you have anything better to do?
Oh, here's another question. Do CEFs, to closed-end funds, ever create new shares?
Yes, they do. And so do real estate investment trusts. This is how they raise capital. And if you're let's look at depending on the situation. On the REITs, I'll put that aside for a minute, but closed-end funds, if they want to have more capital to invest, they either need to sell existing holdings, which they will do opportunistically based on value, right? And they also, they can issue shares to get more cash. So there can be dilution. But the ones we want to pick are ones that show that anytime they do that, they add to net asset value with the investments they make. So it's a pretty good indicator. NAV is a pretty good indicator of how good they are as investors.
Okay, and there's a question here. Is this best done through an advisor or done on one's own? I guess that relates back to the annuity question. Isn't the person
you mean moving an annuity or getting out of one, or?
Well, I don't know what it relates to. I think it was in the middle of another question. Maybe the person that asked that could clarify. Let's see. Why was a closed-end fund created by the creators?
I'm not sure if this question means invented in the first place or why anyone starts them now. My suspicion is that when they were first started in the 20s, 30s, and 40s, that it was a way to make an investment partnership available to non-wealthy people. Because if you think about it, it's an investment fund, right? And at the time, you had to be a wealthy person to invest that way, to get a partnership that invested in various other securities. And that same principle is what led to the more traditional mutual fund that we know today. Because I'm a bit of a history nut, things changed dramatically after World War II, which is when, around the time that the open-end mutual fund, the one we know today, was invented. And part of it was we had a disproportionate share of the world's wealth because we had the factories that were still standing. Europe was a wasteland. Japan was decimated. The Marshall Plan, you know, it wasn't just to be out of the goodness of our hearts. We had nobody to buy our exports. So we had to rebuild Europe so we'd have buyers for our exports, and in some ways. Anyway, so we had a disproportionate share of the wealth. You know, people go, oh, the golden era of the 50s. Well, it depended on who you were, but that's a social issue. But so people started having extra money before World War II and so on. People were not used, only the rich really had disposable income to a large degree. So after World War II, we have all this money, we have all these resources, we have the only factories standing, disproportionate share of the world's wealth. The middle class grows for the first time. And the middle class has money to save, and they think, oh, I'm going to invest. Open-ended mutual funds grew because they were much easier to market than closed-end funds. Big, what is it, Massachusetts Investment Trust or something, MMIF, they marketed the heck out of these things for the individual investor, and stocks too. So what did people want to buy? They wanted to buy the stocks of the products they used. Ford, General Motors, Coca-Cola. And it really grew an investor class for the first time, starting in the late 1940s. I don't know, that probably doesn't answer, but it's a little history lesson.
Yeah. Well, okay. We got clarification on the earlier question. Basically what the person was asking, is your approach best done with an advisor, or can it be done by AAII members?
It's not an AAII portfolio or approach. This is something that I do myself. I'm not saying that nobody invests in REITs and closed-end bond funds. It's not like this is, I invented something. Everybody's got something that they want to sell as their proprietary this or that. Anybody can buy REITs and closed-end funds. I analyze them. Other people can analyze them. I do all my own research, but to my knowledge, there's not an AAII approach that does this.
And that relates to another question. Somebody that does, quote, wants to sit on the beach and relax. Can I invest in REITs, bonds, and high yield stocks? And not. That's a yes and no answer, I think.
Well, it's a great question. It's not like it's not like passive investing. It's not like index investing. It's not set and forget. Discounts to NAV go away and become premiums. So it definitely requires active management.
Yeah. A lot of thank yous here. Let's see, if a closed-end fund creates new shares, how do I figure out if it's good or bad for the individual who already owns the shares?
Well, when it's selected, just look at the NAV history. You don't have to see each year what its share count is. And you can get the NAV history on CEF Connect for any closed-end bond fund. Excuse me, for any closed-end fund, not just the bond funds. And look for relative consistency in NAV over time. That is generally increasing, generally stable, because if it's stable, you're still getting your income. You're just not, you're not getting the price appreciation. But on the bond funds, we're looking for the income. And if NAV is consistent, then you know that whatever share issuance they have been doing increases or is effective, they're invested for our benefit profitably. Now, you might say, well, they've been good for 20 years and then they lose their minds tomorrow. Well, that can apply to any CEO or any company or any bond fund. But if you're looking at a 10 to 20 year track record, particularly long enough to get over 2008 and 2009, you can be pretty sure that any share issuances that the cash proceeds are being deployed positively.
And there was a question on CEF.com. That was, I think you already answered that.
Yeah, it's CEFconnect.com.
And somebody else typed that in the chat box. So
great.
Whoever asked that question can go in there. Well, let's see, how much portfolio turnover might there be expected following this approach?
Well, it's definitely going to be there. That's a good question. I can't say that there's an average annual amount, but what I would say is that you could have as much as 33%. And what is that based on? It really depends on how many of your bond funds are going to close that window with NAV, or become popular and be sold at a premium to NAV. Now, as long as the yield is pretty stable, I can get pretty close to NAV, and we're not you're not necessarily going to sell it. And then the REITs are more likely to be long-term holds. So, I mean, I don't know, 25 to 30%, but that's going to be a lot in some years. And in some years, in some years I've had hardly any. This year, a lot, because there have been a lot of deals going on. And what I tend to do in market downturns, I never know where the bottom is. But this has worked for me in 2000, 2002, and it worked in 2008, 2009. If I see a better opportunity for yield and value, I will sell something that is a decent yield and value for the better. And eventually, there's nothing left. I mean, it's a little dramatic. And then you're at the bottom. Now, with this portfolio, I didn't have to do a lot of that. I picked up Simon, sold off some mortgage REITs that had done fine, but I could use those for the cash, that kind of thing.
Yeah, 30% turnover doesn't sound like much to me. Some mutual funds, they get as high as 100% sometimes.
Absolutely.
They all over the place. You may not want to answer this one. You may want to do it privately, and the person that asked it would. So I suggest you contact Tom. But can you show your performance chart and your drawdowns? You may not want to answer.
Yeah. No, that's a very good question. And I'm so pleased. I want to bow down that this questionnaire used the term drawdowns. I mean, drawdown, it's just like everybody thinks they lose money when prices go down. And they haven't lost any money. It's normal. Prices, but people expect, not AAII members, but a lot of people just expect their prices never to go down. And it's just crazy. Yeah, I'd be happy to talk about that. I'll tell you, this year's drawdown pretty substantial, except of course in March and April, but had like a 30% rebound since then. But again, the yields are consistent, and I think this is one of the reasons that I mentioned having asset allocation, because if you have, let's say you have, I'm just throwing this out there, 50% in this approach, and then you have like some amount in one of the asset allocation approaches on lazyportfolio.com. Lazyportfolio.com has some wonderful asset allocation strategies. I'm not recommending any of them. What they do is they show you how to analyze potential drawdown for the biggest drawdown you might have in a strategy. So for example, high yield comes with potentially higher drawdowns, max drawdown. Asset allocation, which has lousy yield, right? I mean, remember the S&P 500 yields 1.7% today. So you're not going to get anywhere just with the yields from the S&P. You might get other things from it. So you'll get maximum drawdowns over a 20, 30-year period of various strategies. I am so glad to have received this question. I recommend any investor look at lazyportfolio.com as an education.
Okay, there's a question related to taxable accounts.
Yes.
Comment on that?
Yeah, in taxable accounts, you want to have something allocated to the municipals, of course. You are going to have dividend tax. You're going to have, but you're not going to have, income tax as if you were withdrawing from your IRA. Well, your traditional IRA, not your Roth, where you're not taxed at all. I try to manage as well as I can, and you can too, for end-of-year tax consequences. But in my investing career, I've found that if you pay attention to the investment strategy, taxes take care of themselves. Is the term the tail wagging the dog? I wouldn't want the tax strategies to dictate the investment. And if someone really wants, no tax consequences in the taxable account, they probably should just stick with municipals and pick some and never sell them. If they can find enough of them that yield over 4%, then that would work.
Let's see, that one just added, preserving principal in this approach is intended to preserve for an estate. I need to reword that, but anyway, if we want principal and other reasons, it might be best invested in a different way.
I'm not sure I follow.
I'll read it directly and help you help me interpret it. Preserving principal in this approach is intended to preserve for an estate? Question. If we want principal and other reasons, it might be better invested in a different way.
Okay, I think what this means is, what if I don't care about or need to preserve the principal? Would I want maybe more capital gains than income? Is the only way I can sort of think of that. This is particular for income generation. If there are other goals besides retirement income, then other strategies would be called for. This is a retirement income strategy. I mean, obviously, we do all sorts of strategies for clients. This is the one that I've written about that I use in retirement. But if I have clients who just don't want the volatility, then I do this with asset allocation to temper the volatility. And I'm not saying, I'm not saying you're going to get greater volatility and greater drawdowns. I just want people to understand, like the periodic table, different asset classes are going to have better and worse years. And that's just the way it is.
We've had 2 or 3 questions and I've avoided it, but a lot of people are asking, what's your management fee? If you want to answer that here privately again.
1%.
Which is certainly competitive. Lazyportfolio.com, I say is not active. Do you mean lazyportfolioetf.com?
That might be right. And if you looked it up, thanks.
Well, somebody did.
Yeah, I know. Thank you for doing that.
Jerry looked it up.
Great. Yeah, it's a fun site. I don't know how well, I don't know how reliable the statistics are. I have no reason to doubt them, but I think it's very educational to look at different ETF strategies and their max drawdowns. I'm a big fan of people doing their own investing in a Vanguard type world, a low fee ETF world. I believe in low fees. My business is to provide a lot more individual interaction if wanted, and also a particularized active approach. But I worked at the Motley Fool, and there is no bigger fan of how can I put this, anti-Wall Street than the Motley Fool. So my bias.
Yeah, they are good.
Yeah.
So is it Lazy Portfolio? What is it? Take a second. And I'll read the next question. Oh.
Yeah, he's right. Lazyportfolioetf.com.
Yeah, and there was another participant here that just typed that in the chat box as well. Lazyportfolioetf.com. A couple of people did.
And I think an interesting thing about that is I think people tend to be surprised by how substantial the max drawdowns can be for certain strategies. And there's always a trade-off between return and volatility. It's the way of the world.
Yep, can't get one without the other. And this will be the last question since we're at the end of the hour here. The prices of many bond funds during June and July have slowly been percolating back to near their values prior to the March crash. If the prices of some have not, is that a sell signal? That'll be our last question for the day.
Well, I love the question because the questioner has already noted that that long-term NAV can be an indicator of manager prowess. Absolutely. But you know what the answer is going to be. For me, it just makes me, I'm going to have to drill down further, because I'm an analyst, I'm a fundamental analyst. I'll look at something like that, and then maybe I'll determine that it's a short-term factor related to the particular kinds of bonds that the fund's mandate requires it to invest in. But I just, I just can't say it would be a sell signal. It requires more data.
Right. And bonds went through a crazy time in March because everybody wanted cash. They didn't want bonds, they wanted cash.
Yep.
It was a wild ride for a couple of months, but whoever asked that question.
Well, the third week of March, I mean, I have to be honest, I'm a pretty cool customer when it comes to investing, but I had one night where I tossed and turned, and it was the third week of March.
Yeah. Yeah, I didn't understand what was happening with bonds very well either, but it has corrected. I think we're to the end. Everybody's got Tom's email address there. If you got any more questions, email him. We're going to have to just leave it at now. We're at the end of the hour. Tom, on behalf of everybody that joined us today, and we had over 100, thank you very much. Excellent presentation. Several favorable comments here in the chat box. And of course, I appreciate it, and thank you very much, and success going forward. Anybody that wants to continue the conversation, Tom's information is on the screen.
It's a great pleasure and great questions.
Right.
Thanks, everybody.
And we'll see everybody back, and look for your email, and Craig Israelson on September 5th. Mark these down. It will be September 5th, October 24th, and November 7th. Those are our upcoming meetings. And again, you can find those meetings on robertsfinancialmanagement.com. September 5th, October 24th, and November 7th. And then we'll get started with next year. In fact, on the website, we've already got a couple of speakers for next year. Paul Merriman, for example, is in there. Tom, many thanks. Success to you. Good health. Avoid the COVID mess. And I had one person the other day sign off, and I thought it was good. Is okay. Everybody go wash their hands.
Very good. Very, very good.
All right. Everybody stay well. Enjoy the rest of Saturday. And Ed, thanks again for setting this up. Appreciate it. In fact, Ed, I'll give you a call here in just a second. Tom, thank you.
Thank you.